Thank you very much for doing this again, Phil. Pleased to have you on. As usual, we're going to let you drive for a bit and tell us about the trust, and then we'll get to some questions. So if you've got any questions, please do put them into the chat box on YouTube. Over to you, Phil.
Great. Thanks, James, and thanks for the opportunity as ever to speak. By way of introduction to those I haven't met before, my name is Philip Kent. I'm the Chief Executive at Gravis and have been the lead fund manager on GCP Infrastructure for the last 7 years or so. In terms of today, I'm going to give a brief overview of the fund, capture, what I think is the current market opportunity, given some of the market dynamics that you've heard in the call so far, and then touch a little bit on where I see the UK infrastructure market landscape and current opportunities. So to dive into the fund, first of all, so GCP Infrastructure focuses on UK-based infrastructure, where that infrastructure has some form of public sector-backed cash flows, with a focus in investing on debt, so picking up the top line of this slide. In terms of some of the history, we IPO'd back in 2010, so this year marks our 15th anniversary from IPO. We've been a FTSE 250 constituent for the last 10 years or so. Market cap of the fund is just over 600 million, net asset value of 911 million, and total investment value of around 950 million. The difference between NAV and investment value really is debt, so we're not a highly geared structure. At the 1st of December, we had net debt, of just under 20 million or so. Perhaps skipping to the next slide, if we could, we run through on this slide the core objectives of the strategy, and these objectives have remained entirely consistent with those that we set out at IPO. Firstly, income. I think for most of this strategy's life, income has been the key reason why investors have found infrastructure as an asset class attractive. The fund's paid a stable, sustainable dividend now for the last 14 years. I'll come on to describe why I think that the portfolio is better placed now to continue to sustain and maintain that dividend than it has been over the life of the fund. And a core part of that goes to the second objective, which is diversification. The fund's had the explicit objective of targeting a diversified range of asset classes since day one. What that's meant has actually been really important for the strategy, given the change that we've seen in certain infrastructure asset classes over the last 15 years or so. We've seen asset classes like solar, PFI, PPP, wind significantly mature over that time frame, going back to the early discussions we had on solar with our investors. I think there were concerns on how those assets would connect to the grid, how they'd be managed in the context of the UK market, how the accreditations would work, what the risk was for a new asset class, the fact that investors didn't believe there was enough sun in the UK, all of which, as risks, have largely reduced over time just through the deployment of that asset class at scale. But also we've seen competition coming into the asset classes, and that combination of competition plus a better understanding of risks meant that discount rates, returns available in those asset classes has come down over time. The fund's reaction to that hasn't been to live or die by the evolution of those asset classes. It's been to move into other sectors that we find interesting, where we can capture, in our view, enhanced risk-adjusted returns by virtue of the fact we're coming into those sectors early when they don't suffer from competition and evolution of risk. The third objective on the slide, capital preservation, is absolutely key for us. There's two aspects to this. I think infrastructure by its nature is a defensive asset class. It benefits from the intrinsic value of physical assets that are performing a role for society over the long term, but also the fact that we focus on debt rather than equity investments within infrastructure means we're very focused in an investment process on how we get paid back. And all of the debt in our portfolio fully amortizes over the life of our investment, so there's no underlying exposure to residual value risk or bullet repayments at the end of an asset's life based on some perpetual value or long-term growth assumption. The KPI that we quote on this slide, so the 0.41%, what that is if we take the aggregate impairments or realized losses that the fund has occurred over its 15-year life divided by the total amount we've invested on an annualized basis, we get to 0.41% as a equivalent loan loss ratio or loss given default ratio. That reflects really well against any equivalent returning credit instrument. That number would typically be up in the 2% range for an equivalent yielding credit instrument. So for me, that demonstrates the quality of the underwriting process and the historic asset selection that's been the case for this strategy. The final box on this slide is ESG. ESG hasn't been a core objective of the strategy. And certainly when we IPO'd, ESG wasn't as important to many investors as it is today. But actually where we've ended up from an ESG perspective is a really positive place. We have just under £1 billion of assets, all of which have some form of key environmental or social purpose. And we've done a lot of work over the last 2 to 3 years to try and draw that out in quantitative terms in the interim and annual reports. And I'd encourage investors to look at that in terms of the positive impacts of the strategy. Moving to the next slide, and we present here a snapshot of the portfolio in the pie charts. Go into the inner pie chart first of all, the broad mix of the portfolio that we identify. Renewables make up just over 60% of the portfolio. And to my diversification point, you can see in the outer pie chart there how that's made up across multiple asset classes: solar, both commercial solar and rooftop solar, wind, biomass, anaerobic digestion, hydro, and some smaller exposures to other asset classes. Just over a quarter of the fund is invested in PFI PPP projects, predominantly in the healthcare, education, waste and leisure sectors. And then 12% of the strategy today is invested in supported social housing. And we've publicly set out as part of our capital allocation program that we'll be reducing our exposure to that sector over time. To work through the boxes on the right-hand side that give a few more KPIs on the portfolio valuation, 955 million across 50 investments. That's made up of a significantly higher number of underlying assets that sit within those investments, so well diversified from an asset perspective. The investments have a weighted average life of 11 years. A key metric for me is the fact that just less than 1% of the fund is exposed to a construction risk. That's a fairly material reduction in construction risk that's occurred over the last 5 or 6 years. If we go back in that time frame, that level was up at 16-17%. So we've been through the construction and commissioning phases in some asset classes that have presented themselves with challenges for us and others in those phases, biomass, anaerobic digestion as examples. But where we are now is that we have a mature, diverse and operational portfolio that operates well, including in respect of those asset classes where we've had historic challenges. And then the final one to pick up here is the bottom box, where we set out that just under half of the investments in the portfolio have some form of inflation protection, and that provides a natural hedge against the income generated by the portfolio in a higher rate environment. And we've certainly seen the benefits of that accrue to net asset value over the last 2 to 3 years. The following slide has a slightly different take on the portfolio. We break down the portfolio by income type, so the same inner pie chart there, but around the outside we set out where the revenues of the underlying projects are coming from. And as you can see, the vast majority of the revenues in the portfolio are underpinned by long-dated, inflation-linked public sector-backed contracts, whether that's a unitary charge under a PFI or PPP contract. That's the core payment mechanism under contracts with central government or local authorities. And then the various renewable subsidies, such as the renewable obligation regime, the feed-in tariff and the renewable heat obligation. And then in the supported social housing sector, the government-backed revenue there is really underpinned by lease income that's backed off with housing benefit. The portfolio as a whole is generating just under 8% as a yield. What is available in the current market today in terms of what the underlying portfolio can be accessed by investors is a dividend yield of just under 10%. I'll come on to talk more why I think that's an attractive entry point. And that's a dividend that we've paid consistently and stably now for the last 40. The next slide tries to draw out an example of the portfolio. This is an investment that we made back in 2017. It's a senior debt facility that's secured against the UBB Waste Gloucestershire waste to energy project. That takes the vast majority of Gloucestershire's black bag waste, and it burns that to produce electricity that's exported and would provide around 25,000 UK homes with renewable power. Takes in around 190,000 tonnes of waste every year, generates around 15 megawatts of capacity. That's equivalent to the 25,000 homes that I mentioned. And that's been procured as part of a 25-year concession with Gloucestershire County Council. And I think this is an excellent example of where Gloucestershire had a challenge in respect of their waste and where it was ending up in terms of going to landfill. And then, as with any PFI PPP scheme, worked with the public sector to procure a financing model where the equity in this, and the original equity was a combination of Urbasa and Balfour Beatty, developed and were awarded and then built and operated and now operate this project. The senior loan, we have about 40 million outstanding. The loan's valued in our books at par. The overall interest rate on the facility is just under 8%. And as I set out earlier, that loan fully amortizes out to maturity in 2042. We did an investor site visit at this asset a year or so ago. I would encourage any investor who would like to be involved in those visits. I think it's an excellent opportunity to go around an asset and see it working in reality. And I think it also gives investors a real insight into the risks ultimately to which they're exposed. These are complicated operational assets, and there's a big diversity of operational risk in our portfolio, from solar and wind, which is relatively simple operationally, compared with assets such as this, which are very multifaceted in terms of processes and operational involvement. Perhaps move into the next slide, if we may, James. I think what we set out on this slide is a little bit of market position, and you heard from Andrew, I think, some really good commentary, I thought, on the listed renewables space. And this fund is often put in the peer group of the wider infrastructure equity managers, the renewables peer group as well, given the mix of the portfolio that I just set out. I think the first distinction I wanted to make on this slide is a difference between us as principally a debt strategy versus the other equity strategies that are out there. We're very aware of the other listed debt fund in Sequoia. We really like those guys, and they've done a good job for investors, but they do focus on something that's slightly different from us, more focused on economic infrastructure. That's perhaps more GDP linked in terms of its performance. It has more perhaps demand risk in the revenues. It's a more geographically diverse fund, and perhaps has participated in more debt that's been originated elsewhere, rather than everything in our portfolio is bespoke and bilateral. GCP's focus has historically been on more environmental social infrastructure. That's more availability based in terms of the revenues generated by the underlying projects. So what that means is the projects are paid for being available for use, not based on how much they're actually used. And that's typically a more resilient basis of revenues. And certainly the capital allocation program that we've set out puts us more into that debt space as we look to exit some of the equity positions that the fund has acquired over time. I think, without going through the rest of the peer group, perhaps a distinction I'd make there is between an infrastructure risk versus a more private equity style risk. And I think we see a bit of a spectrum across the sector in this respect. For me, an infrastructure risk, and very much how we think about lending against infrastructure, is looking at an asset that does a job over its life. And our job is really to due diligence that asset over its life and understand the cash flows and the risk to those cash flows over the asset life. We're not thinking about a management team or entry into new markets or growth opportunities, and that feels much more like a private equity set of considerations. And I think if we're looking at some of the wider peer group where we've gone into regulated utilities, for example, that is a corporate that's got a regulated, non-regulated business. It's got employees, it's got pension liabilities, it's got a business strategy that may change over time. Similarly, as you're looking at some of the funds going into more developer vehicles, that's backing a management team to go out and use their relationships to procure consents and the enabling factors for a project that then they might sell or they might indeed develop. And again, that feels more like a private equity style risk. And this isn't me sitting here saying one is better than the other. The listed infrastructure equity fund in the top right there is 3i Infrastructure. That's done a great job for investors and is explicitly a private equity strategy within the wider infrastructure peer group. So this isn't a comparison of good or bad. I think it's more to highlight the difference, which I think it's important for investors to appreciate. And the final point I'll make here is that GCP does occupy some white space in what is a relatively congested wider peer group. So I think if we're looking at longevity of the funds and the role each fund has to play on an ongoing basis, I do think that GCP has a core differentiator in terms of its offering versus that wider peer group. To the next slide, I wanted to summarize the opportunity as I currently see it. And these charts, I'm sure, will be familiar to many listeners. So on the left there, we set out the UK's central bank rate evolution and look how that's evolved from IPO. And on the right there, the 10-year gilt history, which, given the fund's duration is approximately similar to that, I think is a relevant risk-free comparator. I think interestingly on that right-hand chart is the fact that that gilt rate is approximately the same as where the fund was at IPO, or where the gilt rate was at IPO going back 15 years. At IPO, the fund traded at a modest premium and sustained that premium at 10 to 15% above NAV for the majority of its life. Arguably at that time on a relatively untried, untested model in sectors that were newer and a mix of construction and operational risk in a vehicle that was scaling. Fast forward to now, we have a scaled vehicle that's materially operational, has a 14-year track record of paying a stable dividend, yet we find ourselves at an unprecedented discount. So perhaps go into the next slide if we may, James. Just to summarize the history of the fund, so the black line there shows the dividend that's been paid over time. As you can see, it's remained stable, with one dividend reduction that we made back in May 2020, really in response to a low interest rate environment that preceded for the last 5 or 6 years prior to that point. Last year, we repaid all of IPO investors' subscriptions through aggregate dividends that the funds paid out over its life. I think it was a really important milestone. And then the green line here shows the NAV and how that's moved. And it's moved about a bit, but I would argue in some of the context of some of the macro events that has punctuated that period, Brexit, nationalisation concerns, COVID, mini-budget, the geopolitical tensions that are continuing, the NAV hasn't moved about very much. And actually infrastructure, if we're evaluating this slide, has largely done what we set out it should do. It's uncorrelated, it's defensive as an asset class. Yet we find ourselves at this unprecedented discount, which is shown on this chart here. It's just over 30% where we sit today. That's in the context of a mature operational portfolio that's paid a stable dividend for the last 14 years. I think the benefits of inflation protection across the sector more broadly has probably been underestimated in terms of the response to the wider rate environment. We have no interest rate risk in the underlying portfolio where there is senior debt and we're sitting in a subordinated position. That debt is all fully hedged with swaps in place at the underlying asset level. So for me, this demonstrates why there's such an excellent entry point to this fund, and I'd extend that to many of the strategies that Andrew mentioned earlier that I think have suffered from the same dynamics. In my mind, this discount really is a function of two things. Firstly, the fact that there's been a re-rating, and in a higher interest rate environment for a relatively long duration fixed rate stock, there is a natural re-rating that would happen in those circumstances. But the second thing, and I think this has probably had an outturn impact, is just a massive reduction in liquidity in alternative sources of income. And we've seen money flow out of sectors like infrastructure, renewables, in favour of perhaps more traditional sources of fixed income, so money market funds, gilts, and corporate bonds as an example. The next slide talks to the wider opportunity I see at the moment. And I apologise in advance for what is a very busy slide, but that's kind of the point I'm trying to make here. This country has set out some really aggressive targets in respect of decarbonisation. And I focused on this slide on decarbonisation. I could probably have a similar slide for the response to population change in terms of a growing and aging population. and the role infrastructure has to play there. I could probably have a similar slide in respect of digitalization as a macro theme. But focusing on decarbonisation, this government has committed to achieve a low carbon grid by 2030. That practically means is all of the electricity generated and used in this country will be from low carbon sources, including nuclear, and they've capped in that the component of gas generation. But that's a massive undertaking from where we sit today. And by the government's own estimates, as you can see there, will require 140 gigawatts of installed capacity within renewables. That's up from just over 60 or so gigawatts that we have installed today. So a massive increase in renewable deployed capacity. If we look to other sectors, heat, transport as examples, almost 40 million EVs will be required on the road to get to the 2050 target, which is the whole economy will be net zero by that point. That's up from just over 1 million electric vehicles today. I think the same story for heat pumps. It's 30 million heat pumps installed. We've managed to install around 225,000 heat pumps in this country over the last 5 years. So there is a step change needed. And frankly, my perspective on this is whether it's 2030 or 2035 that we hit these targets, I don't think is the material point. The direction of travel here is really positive from an investment perspective, and we're starting to see policy aligned to promote this. I think there's some really interesting mechanisms that have been introduced around the cluster model. So how we look at the carbon removal model, the hydrogen business model that the government is introducing, that's taken the contract for difference model that's been really successful, particularly in offshore wind in the UK, and applying that to different markets to try and promote investment in new capacity. So there's lots going on in the background, and actually this is and should be, and during a period higher rate environments, a good opportunity for lenders to be investing into some of these new mechanisms, doing what this fund has arguably done really well over the last 14 years, which is getting into sectors early and taking opportunities in those sectors, capturing high rates whilst we're doing it, in the context of the new policy environment that's occurring. The final slide I wanted to touch on is just a bit of a wrap up. We think at the current discount, the fund represents a really attractive entry point. We've paid a sustained long-term income historically, and the fund and portfolio have never been better placed, I'd argue, to continue to do that. And we're seeing the macro environment hopefully align as well. So the prospect of rate cuts, albeit perhaps slower than we all had hoped, I think will address one of those factors at least that I attributed the rating to earlier. So on a relative basis, these funds will look more attractive. And we're seeing an alignment of government support to promote new investment. And the ongoing work on cost disclosure, let's not underestimate the impact that has had as well. And I think it's really important looking ahead to the composite cost index discussions and consultation that's currently out, that we're making sure that investment companies are accurately and fairly reflected from the perspective of as part of that. I'll pause there and very happy to take any questions through the chat room or I think directly to James.
There I am. Very good. Thank you very much, Philip. And so there's loads of questions actually, but there's some sort of theme to some of them. So I think to come back to the structure a bit and the dividend, if we go back to this one. So the dividend was obviously cut in 2020, and as you said there, in response to the fact that the rates of interest available were come down, but obviously the rates of interest have gone back up again. Do you think there's a possibility of dividend growth from this sort of level?
I do, and I absolutely acknowledge that the dividend cut was in response to a low rate environment. I think the challenge I have is what we've said to investors and what investors have said to us in the current environment is, let's not invest now, let's return capital to shareholders through buybacks, let's deleverage, both of which we've started and have committed to. Leverage has been materially reduced over the last 12 months by around £100 million. We've started a programme of buybacks as part of a commitment to return a minimum of 50 million to investors. So the challenge there is, unless we're investing into that higher rate environment, we're not going to reset the return generated by the portfolio that can therefore lead to a response through dividend. I think the core discussion we're starting to have with shareholders, and this is definitely more of a theme in the discussions we've had over the last 3 to 6 months or so, is, well, what happens next? Does a company, once you're through the 150 million of aggregate deleveraging and buying back, what happens then? And really, that's going to be a function of where the discount has evolved to through that process. But I think there is increasingly a set of investors that are taking the view, well, buybacks haven't really worked, deleveraging hasn't really worked, selling assets at NAV hasn't really worked. So actually, are you better off just investing to invest into the prevailing risk and return environment? And by doing that, ultimately, you're resetting the portfolio into the current market, and that should drive a re-rating. So if we do that, then I think absolutely there's the scope to look at dividend again. I would make the point, and I've often referred to, it's a £1 billion portfolio. It's a bit of a super tanker. We can't switch it from today overnight, so it will take time. And I think for me, capital recycling will continue to be a theme. So the proactive disposing of assets or recycling debt through promoting early repayments from underlying borrowers, such that we can reset that quicker. But it's not going to happen overnight.
On that point, if the social housing deal happens, is it one big sale and one big transfer of cash?
I mean, yeah, so we're looking at a number of options there. We've said publicly that across GCP and Gabi, with the other fund that Gravis manages, that's currently in managed realisation, that we're looking to exit supported social housing. Clearly, I think it is more attractive for certain types of investor to look at a larger transaction, and I think that's a unique selling point in terms of what we can offer. The portfolios in both cases are made up of exposure to a number of different registered providers. So I think it's really a balance between optimizing the makeup of those sales processes to investors to maximize value. But we're not, I think it's going to be a lot more straightforward and actually better if we can commit to that in larger transactions rather than many smaller transactions.
Makes sense to me too. If you were investing a brand new portfolio today, would it be all renewables? Do you think is that the way it's going?
Yeah, it's a good question, and I think the fund's portfolio makeup historically has really been a function of where the UK government are looking to support, and the reality is that there are support mechanisms available in renewables, principally the contract for difference model. The biomethane support scheme is another one. And looking ahead to the carbon business model and hydrogen business model I mentioned earlier, there's potential new CFD mechanisms there. I think there are some other areas. So I think the OFTO regime is another interesting support mechanism, which is more of a RAB-based mechanism that we Gravis have looked at quite closely over the last couple of years. I think there's similar mechanisms in the water sector, so direct procurement for customers. So that's a model where new larger infrastructure, there's a couple of aqueduct or reservoir examples in the pipeline, will be funded by a private sector finance procurement scheme similar to PFI PPP. We have also seen derivatives of PFI, the mutual investment model in Scotland and Wales, continue, and a lot of the developed world still has some form of PPP type mechanism to procure new infrastructure. And I do wonder whether, given the state of the government's finances, and at the same time, the amount of social infrastructure we need to build across prisons, education, healthcare, that there is a potential sensible return to some form of private sector procurement model. So today, to answer your question, James, I think, yes, I think the opportunities are immediately in renewables, and probably I would say that's a wider definition than just renewable electricity generation. And I think probably the more attractive opportunities are outside the heavily congested sectors of solar and wind. But looking forward, and I don't think we have to look forward too far, there may well be opportunities perhaps within an even broader definition of renewables, but also in some other sectors as well.
You've got a tiny amount of construction exposure, and you say it's less than it used to be. Does that provide an NAV uplift as some real things finish construction?
I guess given its debt, we don't have that sort of natural value uplift as you move from construction into operations. So I think no is the short answer. The loans are valued at par today, and I expect they will continue to be, unless Mazars, who for this fund is an independent valuation agent, they set the discount rates that we apply to discount the future cash flows to get back to a value. No, I think is a short answer to your question.
And then in terms of kind of how the portfolio matures, what's the sort of average life of the loans in the fund, and how fast is it running off?
So the portfolio has a weighted average life of 11 years. I think the third box on the slide you've got up. There is a chart in the annual report that I'd encourage anyone interested in this topic to look at. And we set out the expected cash flow profile over the remaining life of the fund. I think supported social housing is relatively long dated. So there's a kind of long dated tail to those cash flows that's principally made up of the supported social housing portfolio. Clearly, if we exit that, that would bring that weighted average life in probably closer to 7 or 8 years. I think in terms of the PFI PPP, that's historically where we've been subordinated debt to sit in junior to a senior lender that in a 20-year concession might have a 15-year term debt. We're approaching the period where that sort of final 5 years of fairly significant amortization happens in some cases as we look to those assets ultimately being handed back. So that forms probably a bulk of cash flows over the next 5 to 7 years. And then renewables is a pretty sort of smooth amortization profile between now and when those subsidy regimes start expiring in 2027, in some cases through to 2036, 2037 in others.
Have you ever felt the need to go overseas for investments?
We haven't in this fund. I think it's something that we have thought about and debated extensively with the board over many years. I think that we've never probably had the need to, on the basis that diversification objective that I set out up front has really given us enough scope to invest within the UK. I think investors have appreciated the fact we've stuck to our original strategy in that respect. We haven't introduced FX risks into the portfolio, but also other market risks that I think we've seen realize elsewhere in other particularly renewables markets where I slightly struggle, if I'm honest, to follow kind of government policy and where it's moving for UK infrastructure across a range of sectors. So frankly, as Gravis, we'd need to invest in teams abroad to really understand those specific markets and geographies rather than pretending we know that and understand it from our current base. So it's not something that we've naturally done, but at the same time, I think it is part of our role as investment advisor to the board to monitor what's happening elsewhere. And if we think there are interesting opportunities, to at least be aware of them and bring them to the board's attention and potentially look at them in more detail if and when the fund does have a 25% out of scope allocation that technically could be used for those sorts of opportunities, but it never has been.
The scale on this chart makes the NAV look a bit more volatile than it really is. And if it's sort of cut off at 85, so it looks like it's going up. But what's been driving the NAV fall in the last years, and do you think they're done?
So we do have a certain exposure to more equity-like investments in the portfolio. That's a combination of where we've stepped into assets as a lender and taken control of those assets. And in pretty much all cases, that's been part of a decision that has maintained value for the fund. So an investor shouldn't read we've stepped in as a complete disaster and write-off. It's not been that at all. Other assets we explicitly chose to invest in more equity-like risks and a very highly subordinated debt risk that had no sort of upside benefits, but practically was taking all of the equity risk anyway. So we have, as I think the wider sector has been affected by reductions in power prices. I think the review that's happened more broadly of energy yields, in particularly the wind space, has affected us as well. We went through a process probably 6 to 9 months ago of reviewing our energy yield assessment on those wind assets we have exposure to, and that contributed to a slight reduction in net asset value. So it's been really a story of power prices, asset performance that's been consistent more broadly. There's a little bit of inflation. As inflation has moved around a bit, that's contributed to the NAVs, and OBR inflation forecasts have generally over that time frame come down, and that's flowed through to long-term cash flow, nominal cash flow forecasts that are being discounted, particularly more in those equity-like investments. It has been a core focus of our capital reallocation program that we've set out to try and reduce exposure to those sectors. So I think I would acknowledge that NAV volatility has been, as you say, I think exaggerated by this chart, but I think investors would like it reduced even from that the level it's been at. So reducing equity exposures would certainly benefit that. But yeah, I don't think there's anything portfolio specific, and the drivers have really been consistent with what we've seen elsewhere.
You're probably not going to be able to answer this, but there are a couple of questions about other funds in the sector basing fees on lower amounts of that. Is that something that you'd be open to?
I think fees are, I guess, a consistent discussion between us and the board. Ultimately, recognise my conflicted position in this question. I think the argument I've made, and this is an argument I have seen others making elsewhere, is that we still have 50 investments. We still have the same job to do. For our business, if we went to market cap, a 30% hit to our top line revenue is a material change. And I think Gravis, again, I acknowledge my conflict in making these statements, but Gravis has always provided an excellent service to both the board, who ultimately we report to, but also shareholders. And I think if there are any aspects of what we do that we can improve or do better, then I'm very happy and I think have a track record of engaging with both shareholders and the board to do that. So if there is anything like that, please do reach out, and we're always open to hearing about it. But I think, fundamentally our job is to look after a portfolio of assets. The work involved in that isn't linked to how the market values those assets. It's linked to the thing we can control, which is the value of those assets. So, and I would emphasize that the valuation is done independently of Gravis. It's set by Mazars as an independent valuation agent. So, this hasn't actually been a massive topic of discussion in the discussions we've had with our shareholder base over the last 12 months or so. But I absolutely acknowledge it's a debate in the wider space.
Yeah, fair enough. And another one that, again, is maybe all for the board, but actually there was some attempts to merge this trust with others. And there's a question here about maybe the rump of Gabby could be rolled into this. I mean, is that something you'd be open to?
I think we're reviewing all options for Gabby, and ultimately we're incentivized and absolutely want to secure the best result for Gabby investors as well as GCP investors. And, I think the merger discussions had a clear thesis to it. Not all shareholders bought into that, which is why it didn't happen on both sides. But it's one we'll continually review, and, we're getting through the realization plan on Gabby quite quickly, and I think we returned just under 50% of that fund's capital at NAV within 6 months of the vote passing. So far so good. We realize there's another 50% to go, and there's lots of different options for that 50%, one of which is absolutely looking at this strategy. I would say that, again, recognizing the conflicted position there, that would be a discussion for the board, and ultimately they'd require their own independent advice on valuation and would have a job to evidence that independent valuation. So it has to be in the best interest of both shareholders.
Yeah, thank you. I think we should probably wrap up there. I will just finish with the usual question we do, which is to what extent are you and the team invested in the fund?
Yeah, so we are invested in the fund, and I think we set out the exact number, which changes every 6 months in the interim and annual report. But across Gravis, there's a fairly material holding from individuals in the fund. Certainly from my perspective, it's an outsized holding, and outsized by quite a long way relative to sensible portfolio diversification. But that's the way it should be.
Good. Thank you very much indeed. Sorry we had to wait for a bit to come on, but very interesting and useful, and hopefully you find that useful. And do give us more questions if you have them. So we will be back next week, and our guest is a new face for AVI Japan Opportunity Trust, Nicola Takada-Wood. So we'll be talking to her. Have a good weekend and a nice week in the meantime, and I will see you next week.